All right. So today we're going to be talking about cost segregations and how to apply that to your investment strategy because we can know what to do. We can know the mechanics of how it benefits us on the tax side. But what we want to be talking today about is how knowing that information can help kind of steer your investment strategy. It can steer you in the direction that you want to go with what asset types you want to invest in, what property types you want to pick up, and how to kind of maximize the total tax benefits
Yeah.
of that as well. So we're going to be talking about kind of what to look for in properties, what to stay away from, and what to avoid, and then what to do if you already have a property, an investment property that you already own, and what that could look like for you right now. So, Matt, take us away.
Absolutely. Yeah. So, like getting into the cost seg studies, why they're important, what's beneficial here. Nobody's advocating for trying to do any of this solely for the tax benefits. So you look at an investment based on just the tax benefits, but we can't ignore that math. We've gone in other videos and talked about like what it looks like to underwrite a property with and without taking the tax advantages into account. I think we got to keep our eyes wide open going into any investment, just making sure that we're doing all the math. So what we should look for in a property, we're going to use a cost segregation study on a property. Like what type of property are we looking for to make sure that we're taking full advantage of that? Things to look for specifically, you've got anything that breaks down in 20 years or less is going to have faster depreciation schedule when you run a cost segregation study. Normal depreciation is over 27 and a half years for residential, 39 years for non-residential.
Yep.
And when you're able to take depreciation a little bit faster, that's when you start benefiting from cost segregation study, because you start to front load the depreciation on that end. When you get bonus depreciation, as we still have we have 60% bonus depreciation this year, that allows you to take those shorter timelines and front load 60% of those to year one as well.
Yeah.
And so basically features within a property that have shorter lifespan than 20 years. What types of things are included there?
Yeah, you're looking at flooring, baseboards, fixtures, in terms of like plumbing fixtures, lighting fixtures, things like that. They're going to have depreciable lifespans less than 20 years. And so when you're looking at a property, you're saying, okay, how much of those things does this property have, right? We'll touch on this a little bit later, but like a commercial building that's more of just a shell of a building, right, isn't going to really have a whole lot of those under 20-year lifespan components as compared to, let's just say, an Airbnb that has a bunch of stuff, right? Amenities in there. Maybe they got a pickleball court. Maybe they got all sorts of things around the property that might fit into that less than 20-year lifespan. You're going to have a lot bigger tax benefit depreciating an asset like that versus just a shell of a building.
Right. It's not necessarily just the building we're talking about. You talk plumbing fixtures and stuff. The internal workings of that, the wiring, the copper lines, all that stuff would probably be a longer lifespan, right? I think that's normal full life of those items. But some of the other items, like on the exterior of the building, if you start looking at land improvements, you've got landscaping, you've got paving for parking lot for a large commercial building, any of that stuff. There's some of that breaks down in a faster timeline as well. So
well, that's a great point, because then you look at a different asset class, like let's just say a car wash. We know that to be true. 100% of a car wash is under that 20-year lifespan. And so that makes it super, super powerful. You go and invest in car washes, like a self car wash or something like that. It's like, oh, I can take the full value of that thing, minus the land, obviously.
Pretty close.
Take the full value of all the things on that property, and I can depreciate that on an accelerated timeline. Same thing with something like a mobile home park, which has a lot of land improvements. Maybe you've got a bunch of septics, maybe you've got a bunch of pads poured, maybe you got a bunch of amenities kind of for the community around the area. So that stuff really starts to add up. And you don't have a whole lot of things that actually are over that 20-year period in terms of a depreciable life. Something like a mobile home park, you might be closer. 70 to 80% of the value of that entire park might be able to be depreciated at an accelerated basis. So,
and looking at properties too, if you're looking at what properties should I be investing in to make sure that I'm thinking in this way, also start to consider what things you can do to add to the property as well. What type of land improvements, what type of amenities for like an Airbnb, short-term rental, or just long-term rental, any of those. What type of amenities and extra things can I add that will both be profitable for the rental business, but also benefit the tax side as well.
Right. It helps us as investors because a lot of those purchases, a lot of those value adds, sometimes it's hard to justify, right? You're like, what is my ROI on putting in a pickleball court at the, short-term rental that I own? Or what's the ROI on putting in, a walking path at the assisted living center that I own, right? Like you're like, okay, I get that. I know that it adds value to the tenants or to the people that are staying there, and I know that ultimately drives more business and income to the property. But now you have another metric that's easy to measure in terms of what do I get in terms of my ROI on that thing. So it makes it a lot easier when you can have that mindset of you're going into it, what sorts of things that you can do to improve the property, which not only is going to improve the value, it's not only going to attract the right tenant, the better tenant that you want, improve cash flow, but it's also going to give you the tax benefit. Now you have a real way of kind of measuring that and stacking that up against what your strategy is going to look like. Another thing that we want to talk about too is like when we talk about components of a house, just like when you think about the benefits of multifamily, right? It's like, okay, I have 4 doors across this property that I bought. That helps increase cash flow, it helps spread out risk, all of that. Well, what it also does for you is I might have a 4,000 square foot house, single family, compared to a 4,000 square foot 4-unit quadplex, right? Well, what this looks like in terms of depreciating is, well, in that 4,000 square feet, how many sinks do I have? In that 4,000 square feet, how many toilets do I have? Right. In that 4,000 square feet, how many hot water heaters do I have? Right. And so you start to stack multifamily in there and say, okay, the depreciating components of this building I have more of. Right. So it starts to get your mind might start trending towards, okay, how would I maximize and optimize this in my investment strategy? You might start to look at things like multifamily a little bit more too, for reference there.
Yeah. Overall density of like shorter lifespan depreciable aspects of the property are probably going to increase as you look at smaller multifamily spaces, like 1-1 studios, 2-1s. They're all going to still have the toilets and the sinks and the AC and the water heater. They're still going to have most of those things. And so kind of the higher density, those items within a space can be something to look at as well.
Okay, so those are things that we want to look at as possibilities and maybe set the right mindset for what you should be investing in and how you should be maybe approaching that tax strategy and how to kind of capture the max benefits of that. What should we be avoiding in terms of, hey, I have this tax strategy. I know that I want to optimize this in my investment to capture the tax benefits here using a cost segregation study. What should I avoid?
Yeah, land, land heavy. So we can't depreciate land. Land is eternal. Land is forever. According to the IRS, obviously it could all burn down around us, but according to the IRS, it's going to be there forever. It does not depreciate. It stays the same as far as depreciation goes. And so if you have a land heavy asset or strictly land that you're purchasing, or looking to purchase, you're looking, hey, would this be a good investment? It might be a good investment in hey, I'm going to buy 30 acres on the edge of town, and town grows around me over the course of 10 years. And maybe that's going to be a great investment as a land purchaser. Right. But if you're purchasing that with the intent of like taking advantage of depreciation, cost segregation, any of that, you're not depreciating land. So not super helpful. Super small single family on 10 acres. Good chance that you're not going to be depreciating the same, unless you get into some of the agriculture and farming and timber and all that kind of stuff that can be on other properties. Here in Arizona, here in Phoenix, we don't have a lot of timber, and so it's not really the same thing. There, almond orchards do exist, but they're not on every corner.
Yeah, no, exactly. Another thing that you want to probably avoid, and we touched on this a little bit earlier, but buying, big industrial building where you've got 500 square foot office. It's like a flex commercial space where it's like 500 square foot office and you've got 10,000 square foot warehouse there, and you're renting that out. you don't need to avoid it, but it's just not going to have the same benefits, right? As like going and buying a 11,000 square foot multifamily or some of the other asset classes that you can invest in. So shell only industrial store, like those aren't going to be warehouses. Those aren't going to be massively. And most of the components in that asset class are going to be hitting the 39-year depreciation life cycle. So you just don't maximize the benefits with the cost seg as much.
Right. So we're not saying like don't buy those asset classes. We're just saying like this, it's not the play. Like the tax benefit of that is not necessarily the play in the same way that it could be on other things. Cost segregation study and bonus depreciation. If you're going down that path as far as how you can benefit on the tax end of things for your personal finances, it's probably not the play there. Could you benefit from a cost segregation study on an industrial build? Yes. Absolutely. Yeah. Right. There are still things that can be taken, depreciation in a faster timeline. Large companies that own those buildings absolutely do that, and they take advantage of depreciation of everything within the building as they can, right? As tax efficient as possible if they own that asset class. So could still be beneficial, but not necessarily. If you're looking for, hey, what's the most advantageous if I'm running this as a strategy, as a play, that might be the one that you don't spend your time on.
Yeah, and talking about bonus depreciation, you just brought it up. Yep. That's another thing. You don't want to wait, right? The bonus depreciation is not here forever.
Right.
It's in our current tax code. It's in the current tax bill that was passed, and it used to be 100%. Then it went down to 80%. In 2024, it's 60%. So basically just what this means for if you haven't followed along with any of our other videos is all the components that have a lifespan under 20 years in a building, you're going to go ahead and take 60% of the value of all of that. And you can take that front loaded in year one in terms of depreciation. So that really helps you capture paper losses that you can then use to offset passive or active income if you're deploying some additional strategies there. So you don't want to wait. Like bonus depreciation might not be around forever. It's going down to 40% next year, 20% the year after that, and then down to 0. And so we don't know if it's going to get passed in a future tax bill. Obviously, that depends on whoever's in office and whoever's in Congress trying to pass those things. And so you want to take advantage of it while it's here.
Yeah.
So waiting is the wrong thing to do there.
Right. Time is of the essence a little bit here.
Yep.
So what if I already own a property? What are some things that I need to look at and do in this regard, right?
Yeah. So you can run a cost seg on a property that you already own. And what you're going to do is you're probably going to end up backdating it to when you put that property into service. Right. So let's say you bought a property in 2020 and you've owned it for a few years and it's a rental for you. You can actually go back and rectify that and run a cost seg and take 100% bonus depreciation. So again, for reference, that's taking all the components in your property and you're taking 100% of that value all in year one. And when you run this with other strategies where maybe you're qualifying as a real estate professional status and you're materially participating in that property, or you're running a short-term rental loophole and you're materially participating in that property, that's where it becomes super advantageous because you can take those paper losses that you're going to go ahead and get from the depreciation from your property and you're going to use those to offset active income. It can still be used to offset other income in terms of like your rent income. So again, kind of front loading and filling up this bucket of losses of depreciation is really advantageous and just kind of future planning as well for when you have a high taxable event coming up.
Right. We talk about bonus depreciation as being a supercharger for this sort of strategy.
Yeah.
And it absolutely is. But a cost segregation study on its own is valuable to somebody who owns a property, right? If I'm looking at taking depreciation, we look at our Schedule E and all the items on there that we're taking as income and losses for the property, for the rental business. It's one of those losses that will be calculated there. And so being able to front load any of that, being able to take that in current year could be advantageous to us.
Yeah, definitely. And then just remember, I think we touched on it earlier in this video, just remember that the timelines in which your property is depreciated depends on it being residential or non-residential,
right?
Otherwise known as maybe commercial. That doesn't necessarily mean that the building is commercial, right? Like it doesn't mean that it's a strip mall or that it's rented out to like a business per se, but that could mean your short-term rental, right? Right. And so your actual short-term rental is considered a trade or business. business when you're materially participating in that. And so it turns the lifespan and the components of that house into 39 years. So it kind of slows down the depreciation timeline. So for all those short-term rental owners, like running a cost seg is your way to go ahead and get all the benefits again, because you're not really able to capture as much as maybe a long-term rental would be in terms of tax benefits and some of the depreciation timelines.
Yeah. The jump from the residential timeline to the commercial timeline, as far as how much bonus or how much depreciation can be taken per year, there's a 25-30% difference between what's available depending on the use of the property.
Yeah. So that's kind of how we use cost segregations. It's how we use the information that we know about cost segregations and tax strategy to go ahead and form kind of investment strategies and investment plans for ourselves and for clients. And so if you're curious and you have more questions about that, go ahead and DM us. That's a really good way to get a hold of us on our LinkedIn. We're on there every day. We're posting real things. It's Matt and I. We don't hire that out. We don't have other people posting for us. So go ahead and get in touch with us. We would be more than happy to explain all of this in even more detail than we have. And our goal is to really try and make these tax strategies that for a long time have been reserved for kind of the higher profile investor, real estate investor. We want to make these strategies more common knowledge, because there's a lot of people that could be taking advantage of it. And we run across people all the time that are sitting on this golden egg in terms of what they could be doing and optimizing in terms of tax benefits. And they just have no clue. They might own 10 rental properties and they've never run a cost segregation study. They've never accelerated the depreciation timeline. They've never utilized a strategy that helps them take depreciation losses from their properties and offset their active income. And so it's just mind-blowing for us. We want to try and make these strategies more common knowledge for you. So that's our goal in these videos. So if you like that, go ahead. And if you're watching on YouTube, go ahead and like and subscribe. We're going to be adding to this video library, and we're just going to continue to drop more information about these kind of little subtopics within tax strategy. And so that's what we want to be known for, that we are tax savvy real estate investors. And so we want to help grow you in that as well.